John Templeton was a super smart investor who made a lot of money. But even he made some mistakes. We're going to talk about a few of them today so you can learn from them. Mistake number 1: betting on Japan's unwavering growth. In the late 1980s, Templeton was smitten with Japan's booming economy, convinced that the country's meteoric rise would continue unabated. He poured significant capital into Japanese stocks, anticipating that Japan would become the world's economic powerhouse. However, Templeton's unwavering faith in Japan proved misplaced. The Japanese economy, once the envy of the world, stumbled into a period of prolonged stagnation, plunging Japanese stocks into a deep bear market. Templeton's Japan-heavy portfolio suffered crippling losses, staining his otherwise celestial track record. Key takeaway: investors should approach their bets on any economy with a healthy dose of doubt, even when faced with compelling growth narratives. Economic cycles are inherently unpredictable, and even the most robust economies can face unforeseen challenges. Mistake number 2: underestimating the digital revolution. In the early days of the internet and technology boom, Templeton remained unconvinced of the transformative potential of these emerging industries. He viewed the internet as a mere fad and technology stocks as overhyped speculations. As a result, Templeton missed out on the explosive growth of tech giants like Microsoft and Apple, leaving significant returns on the table. Key takeaway: investors should remain open-minded and adaptable to the emergence of disruptive technologies. The world is constantly evolving, and new innovations can revolutionize industries in ways that were previously unimaginable. Mistake number 3: diversification gone wrong. Templeton was a true advocate of diversification, believing that it served as a shield against market volatility and enhanced overall returns. However, at times, Templeton's pursuit of diversification became excessive, leading to portfolios that lacked a clear focus and underperformed market benchmarks. His funds, holding a wide array of disparate companies from various sectors and regions, struggled to generate consistent gains. Key takeaway: while diversification is essential for mitigating risk, it should not be pursued to the point of diluting the portfolio's overall quality. Investors should strike a balance between diversification and having a concentrated portfolio of high-conviction stocks. Mistake number 4: over-reliance on technical analysis. In his early years as an investor, Templeton placed significant emphasis on technical analysis, using charts and patterns to predict market movements. He believed that these technical indicators could provide insights into future market behavior. However, as Templeton's experience grew, he came to recognize the limitations of technical analysis and shifted towards a more fundamental approach. Key takeaway: technical analysis can be a useful tool, but it should not be used as the sole basis for investment decisions. Fundamental analysis, which delves into the underlying value of a company and its long-term prospects, provides a more comprehensive understanding of a company's investment potential. Mistake 5: succumbing to emotional biases. Even Templeton, the seasoned investor, was not immune to the pitfalls of emotional biases. At times, he allowed emotions to cloud his judgment, leading to hasty decisions and suboptimal outcomes. For instance, in the aftermath of the 1987 stock market crash, Templeton succumbed to fear and sold off some of his holdings at depressed prices, missing out on the subsequent market recovery. Key takeaway: investors should strive to make rational, unemotional decisions based on thorough analysis and a long-term perspective. Emotional biases, such as fear and greed, can lead to impulsive and regrettable actions that undermine long-term investment goals. John Templeton's investing mistakes serve as valuable reminders that even the most experienced investors can make errors in judgment. However, it is through acknowledging and learning from these mistakes that we become better investors. Templeton's legacy demonstrates that success is not about being infallible but about having the humility to recognize and learn from one's missteps.